Hello and welcome back. It's the earnings season as well. So let's start with Indiabulls Finance. They declared their numbers overnight. Gagan Banga, Vice Chairman, MD and CEO of Indiabulls Finance is now with us. So when we look at the NII number, it has declined. What has led to the growth in profits and declines in NII? Do you think that provisions are sufficient to give any slight increase as far as cross NPAs are concerned in the coming future?
So the strategy that the company adopted last year was one of safety and caution. There were essentially two parts to our strategy last year. One was to concentrate on strengthening the balance sheet to make it even more fortress. And as we did that, we worked on raising capital. We raised almost 3,800 crores of capital between a QIP, some stake sale, and a convertible bond. We also continue to use the profitability that we derived through the year to create large provisions. So as the business stands, we are provided about 3.7% of the loan book, and which adds up to almost 3 times of what is required under regulatory provisions. So the provisioning level is very, very comfortable. The asset quality has actually stood up fairly well through the course of the last 4 quarters, and between the first and the fourth quarter, the net NPA has actually declined marginally. On your point of net interest income, again, through the last 4 quarters, we've tried to make sure that our margins stay stable, even as we are migrating, letting go of our wholesale assets, ramping up on our retail disbursements. So spreads have remained fairly stable at about 2.7%. There was a one-off of a refund around interest on interest as directed by the Honorable Supreme Court, which had a small impact on quarter 4 net interest income because of the refund that we had to do. And that has resulted in the marginal decrease in quarter-on-quarter kind of net interest income. Aside of that, through the 4 quarters, we've been able to build a very, very stable sort of an earning profile. Even more importantly, we've been able to significantly strengthen the balance sheet from a capital, from a gearing, as well as a provisioning perspective. And now we feel that, with all of our partnerships having come in play, everything else which was required from an asset-light model, the low-cost tech-led distribution, that's also more or less done. We've created a fairly good base through fiscal 21 to ramp up disbursals through fiscal 22, and by the end of fiscal 22, actually hit a run rate of about 2,000 crores a month.
Gagan, the Q4 GNPAs have risen slightly compared to last quarter, but given the impact now of the second wave being far more severe, what is the outlook on the NPA trends that you foresee, the collection efficiency in segments in which you are present?
So, through the course of the last 12 months, or even I would say to the last 30 months, as the company chose to adopt a strategy where, in times of uncertainty around both the NBFC sector as well as over the last 14 months around the macroeconomic scenario itself, we've chosen to actually lower our gearing, degrow the book. So from a peak of 1.3 lakh crores, we are down to actually 66,000 crores. And thus the gearing has reduced. As that has happened, the vintage of the book is gone up, as we've detailed in our release also, to almost 4 years. So it's a very seasoned book, and because it is a EMI-based book, the principal has been running down, the equity of our borrowers has been increasing, the loan-to-values have been reducing, and therefore our borrowers are usually incentivized to keep their loans regular, which is reflecting in the collection efficiency. In March, it had gone up to 98.5%. Even through April, when most of the states had gone into lockdown, it had only declined to a little over 98%, so around a 30 to 40 basis points decline. So COVID 2.0 is something that, from a balance sheet perspective, I think we've already sort of pre-prepared for it by creating large provisions, by increasing our capital adequacy to 31%. And willy-nilly, because of the strategy that the company has followed, we are sitting on one of the most seasoned books in our peer set. And that should help us wade through this crisis. The good news is that already the positivity rates in most states are now declining to around below 5% levels, which means that hopefully we have achieved the peak. And most probably by June, one is optimistic that things should start opening up. So with that sense, we believe that on a provision basis, we are quite well protected from even COVID 2.0. Even on the gross NPA inch up from 2.44 to 2.66, I would request you to keep in perspective that we've actually been degrowing the book. So as we've detailed, if we had not degrown the book, the gross NPA would have actually been only about 2.31%. All in all, I think it's a very, very stable asset quality that we have been able to preserve through this period of the COVID crisis.
That retail was seeing robust demand, and wholesale as well was seeing accelerated sales and the project's plans. What is the outlook now? Are you going a little bit slow on retail wholesale book?
We've actually already gone very slow, which is why we degrowth. We've adopted a strategy of great care through the period of COVID. We've not tried to ramp up aggressively. So the strategy in front of us is very clear. We will continue to let go of our wholesale assets, and we will continue to ramp up our retail disbursements via our partnerships, our co-lending partnerships with several large banks and HDFC. They're all in place. And I'm quite hopeful that with these partnerships and the capital that we have of our own, we should be able to ramp up our retail disbursements to 2,000 crores. To put 2,000 crores a month in perspective, back in 2018, we used to do about 2,500 crores. So 3 years have gone by. The market has expanded, but we're just going to be going back to that number in a significantly lower cost model. So there is no, sharp ramp up or anything that the company is planning to do. Even fiscal 22 would be an year of careful scale up. The strategy for the scale up is very clear. The base which was required for the scale up is in place, and that gives me confidence that we should be able to achieve these numbers.
What are the key consumer trends that are observed in the retail book and loan against property due to the second wave?
So the consumer trend through Q4 was very encouraging, as as has been widely reported in the media. Sales for real estate projects were at lifetime highs. So were collections, which means that the consumer is out there willing to buy a house, willing to make that sort of a commitment. The last 1.5, 2 months have been more logistical challenges, where how do you step out? You're trying to preserve your health and sanity, and the same for people around you. So, but as things open up in June and as these positivity rates drop down, I'm quite sure the trend which had started in September 20 and had continued up until March 21 would recommence, and we are in a structural shift where the cycle for residential real estate has shifted, and I'm quite confident that with most of the macroeconomic conditions remaining the same, which is low interest rate, abundant liquidity, etc., there should be a robustness that one will witness in Q2 sales of homes. So that's the big consumer trend, and everything else around our book basically structures itself around this big consumer trend.
Last time when we spoke to you, you said about capital raising of about $200 to $300 million. Can we expect capital raising, and what can be the quantum in the coming quarters?
Yeah, so last year, as I said earlier, we very successfully raised over $500 million of capital. And this year, again, we will have to look at what is the appropriate structure. Now that the annual results are behind us, we will engage with our institutional shareholders and other shareholders and key stakeholders to see. So I would imagine that this would be second half of the fiscal year event. But that again, we will have to calibrate it given overall market conditions and what is the feedback of our various stakeholders.
And what is the further update on the AIF approval and the capital infusion by the partner in AIF?
The AIF does not require any approval. We already have a fairly large AIF with assets under management of around 5,000 crores. We are in advanced discussions with two partners to come in, much like we've concluded our onward lending partnerships for our retail book on similar lines to conclude it for our wholesale assets. As and when that gets done, which is expected shortly, one will certainly update the market.
All right, thanks very much, Gagan, for sharing with us your outlook as well as talking to us about the kind of trends that you're foreseeing.